What if your portfolio paid you every single week, not monthly, not quarterly, but every weekend like clockwork? These three ETFs do exactly that, generating consistent weekly income for thousands of investors right now. But here is the part most people completely miss. One of these funds carries a hidden risk that could wipe out your yield overnight if you are not paying attention. If this is your first time here, welcome. This channel is dedicated to helping everyday investors build real income through dividend ETFs and smart investing strategies. I break down complex financial products into simple, actionable information you can actually use. If that sounds like something you need in your life, hit that subscribe button and tap the bell so you never miss a video. Now let us get into these three incredible weekly dividend ETFs. Before we dive into the specific funds, let us talk about why weekly dividends matter so much. Most people think dividends are dividends regardless of how often they pay, but timing changes everything when it comes to compounding and cash flow management. When you receive income weekly, you can reinvest faster, cover weekly expenses without touching principal, and psychologically stay committed to your investing strategy. Monthly dividends feel slow. Weekly dividends feel like a paycheck, and that feeling matters more than people admit. It keeps investors engaged, consistent, and disciplined. Now, there aren't many ETFs that pay weekly, which makes these three funds genuinely special in today's market. The first ETF is XDTE, the Roundhill S&P 500 Zero-Day Options ETF. This fund uses a strategy called zero DTE options, meaning options that expire the same day they're written. Every single week, the fund sells covered calls and cash-secured puts on the S&P 500, capturing premium income and distributing it to shareholders. The current yield has been extraordinary, ranging between 30% and 60% annualized, depending on market volatility. Higher volatility means more premium, which means bigger weekly payouts. Now here's the risk I mentioned in the hook. Because this fund relies on options premium, in a low volatility environment, your weekly distributions can shrink significantly. The share price also experiences some erosion over time. This is not a set and forget holding. You need to monitor it actively and treat it as an income tool, not a growth investment. The second ETF is QDTE, the Roundhill Nasdaq 100 Zero-Day Options ETF. Same structure as XDTE, but built around the Nasdaq 100 instead of the S&P 500. Because the Nasdaq tends to be more volatile than the broader market, QDTE often generates even higher weekly premiums. Technology stocks swing harder, and that swing creates more options income for you. The yields here have touched 80% annualized during high volatility stretches. Think about that for a moment, an 80% annual yield paid to you weekly. Now again, that number fluctuates, it's not guaranteed, but even at half that figure, you're looking at extraordinary income generation. The key with QDTE is position sizing. Do not go all in. Treat it as a satellite holding that generates aggressive income alongside more stable core positions. Many smart investors allocate between 5 and 15% of their portfolio here to maximize yield without overexposing themselves to the downside mechanics of the option strategy. The third ETF is ULTY, the Simplify Volatility Premium ETF. This one is different from the first two. Instead of writing options on equity indexes, ULTY harvests volatility premium across multiple asset classes using a systematic approach. It sells volatility when markets price it too high relative to realized volatility. Essentially, it profits from the gap between what the market expects and what actually happens. ULTY has maintained weekly distributions for extended periods, with yields often exceeding 40% annualized. But fair warning, this fund can experience significant drawdowns during volatility spikes, like we saw during certain market events. When volatility explodes rather than contracts, the strategy takes losses. The fund has recovered each time historically, but you must have the stomach for those temporary drops. For investors who understand this and want weekly income with a different risk profile than pure equity options, Alti offers a genuinely compelling diversification play. Now let's talk about how to actually build a weekly income portfolio using all three. Imagine splitting your income allocation equally among XDTE, QDTE, and Alti. Each fund pays on a slightly different weekly cycle, meaning you could potentially receive deposits into your brokerage account multiple times throughout the week. You want to check each fund's ex-dividend date schedule and distribution calendar, which is publicly available on each fund's website. Also consider the tax implications. These distributions are often classified as return of capital or ordinary income rather than qualified dividends. That means they may be taxed at your regular income rate. Always consult with a tax professional before allocating heavily into any of these instruments. And remember, a physical commercial bank with visible signage on the corner of your street does not offer you 40, 60, or 80% yields on your savings. These funds can. That contrast tells you everything you need to know about why alternative income strategies matter in today's financial landscape. If this video opened your eyes to weekly dividend income, do me a quick favor and hit that like button right now. It genuinely helps this content reach more people who need it. Share this video with a friend who's still leaving money in a savings account earning nothing. And if you haven't subscribed yet, now is a perfect time. Turn on notifications so you catch every new video the moment it drops. See you in the next one.